Hi friends, welcome to EduTap. So today we are going to discuss some of the important MCQs from the topic fund flow statement. Now this topic may not be as much important as the cash flow statement. This statement is not as important as the cash flow statement because practically it is not being prepared by many entities as of now. But still a question may be asked in the examination. So let's cover it. Let's understand what is this statement and how it is prepared. So let's start today's discussion. So let's start our discussion with the first question. In the context of fund flow statement, fund refers to cash and bank balance, working capital, share capital, reserves and surplus, or none of the above. So if you have to understand about the fund flow statement, it's very logical that you should be aware about the meaning of the term fund. You were already aware about the meaning of the term cash when we talked about cash flow statement. But is the cash and fund the same thing? No, they are not the same things. They are different things. And how they are different? Let's try to understand. Now, fund flow statement is going to show us the flow of funds during the year. Now, this fund, just remember it, it means working capital. It means working capital. Now, working capital, it means the capital which is required for the day-to-day working of any entity. Now, if we talk about in formula terms, this is current assets minus current liabilities. Now, current assets and current liabilities, you are already aware of the meaning of the two. Current assets, they are the ones which are going to be converted into cash in a very short span of time. For example, your bank balance, your stock, your debtors, they are all current assets. And similarly, there may be some creditors or any other payables which you have for the short term. They are going to be your current liabilities. We are going to say, okay, current assets may be 10 lakh and current liabilities may be 6 lakh. So working capital is going to be 4 lakh. Now in the previous year, the working capital may be 3 lakh. Now the working capital, it has increased by 1 lakh. Now the fund flow statement is going to explain to us what are the reasons behind this increase in working capital by 1 lakh. What has led to this increase in 1 lakh? Was it that we have issued new shares? Was it that we have made enough profits during the year? Was it that we have sold our fixed assets and we have got some money from it? Was it that we have issued new shares in the market? So we are going to understand what are the reasons behind this increase in working capital. This 1 lakh, this is flow of fund, and what has led to this increase in working capital. This is going to be our area of discussion in this particular session. Now, question may pop up in your mind. We already have cash flow statement. Why this fund flow statement? Now, the thing is that fund flow statement was earlier to arrive in the picture than cash flow statement. Now, the fund flow statement, it is prepared on accrual basis. Accrual basis, we already know about it. We record the transactions as and when they occur, as and when they are due. And accordingly, it may lead to current assets or current liabilities. We have sold some goods, we have not received cash for it. So it is going to be recorded as a current asset. We have bought some goods, we have not yet paid for it. It is going to be creditors and recorded in the current liabilities. So current asset, current liability, it arises from the accrual basis only. And accrual basis is the basis for accounting that we follow. And the logical way was to prepare this fund flow statement. Everyone should prepare this fund flow statement from the accounting perspective. It looks very good. But think about it from the layman perspective. From a layman's perspective, who does not have enough knowledge of accountancy or commerce, he would not know what is this accrual basis, what are current assets and what are current liabilities. He would easily understand what is the meaning of cash, what is the meaning of money. He already understands the inflow and outflow of money. He's already getting money, he's already spending money. So this statement is very much familiar to him. The cash flow statement is easier to understand. So that's why we prepare this cash flow statement, and this is shown as a part of the financial statements of the company. Earlier we used to prepare fund flow statement, but it was not easier to understand it, to make meaningful conclusions out of it, especially by the people who are from non-commerce background, who are not accountants. So that's why we switched to preparation of the cash flow statement, because it's much easier to look at and understand. So fund flow statement is a statement which shows the sources from which we have got the funds and the uses to which the funds are put. Now fund means the working capital. The change in working capital, it may be increase or decrease in working capital. So what has led to increase in working capital or decrease in working capital? This is something which we are going to find out. Working capital means excess of current assets over current liabilities. So it is going to explain to us the change in the working capital position of the company over a period of time. Now the fund, they may flow from internal sources as well, or they may flow from the external sources as well. For example, you may generate funds from your own business, you may make profits and they are going to lead to increase in working capital, or you may obtain funds from outside, you may obtain a loan from the bank. So this is going to be an external source. So I believe now we can easily answer this question, that in the context of fund flow statement, fund refers to working capital. So clearly the answer is going to be option number B. Now let's move to the next question. In which of the following cases there would be flow of funds? Options are building purchased and payment made in shares, purchase of building for cash, payment made to creditors in cash. All of the above would lead to fund flow, or none of the above would lead to fund flow. So we have to identify which of the following transactions would involve flow of funds. Now we know the flow of funds, it means the flow of the working capital. So if any of these transactions is going to be increasing or decreasing the working capital, we are going to say, okay, this would lead to the flow of funds. So let's try to understand all these transactions and whether they would lead to flow of fund or not. So quite simply, there is going to be a flow of funds if there is change in the working capital position of the company. Working capital, current asset minus current liability. So if there is going to be any change in the net of the current assets and current liabilities, we are going to say there is a flow of fund involved in this particular statement. So of the different transactions which are given in the question, we have to identify whether this current asset or current liability is going to change, and then only we can say, okay, there will be a flow of funds or there will not be any flow of funds in this particular transaction. So here we have the transactions which would lead to flow of funds. Now the transactions which would involve current asset and fixed asset. For example, we have purchased a building and the payment has been made for cash. So this would lead to flow of fund. Now this can be inflow or this can be outflow. Current asset and current liability. Cash is what? Cash is a current asset. So this transaction is reducing our cash. So this is going to reduce our working capital and there is going to be flow of funds. Current assets and capital. You have issued shares for cash. You have obtained cash. Cash is a current asset. So again, this would lead to flow of funds. Current assets and fixed liabilities. Now suppose if you have obtained a new loan from the bank in cash, you have repaid any loan, you have repaid the debentures in cash. So this transaction is again going to affect your current asset, your cash is going to decrease and accordingly there is going to be flow of funds. Similarly, current liabilities and fixed liabilities. Suppose there were some creditors which were outstanding, you had to pay money to them and in return you issued them shares or you issued them debentures. So your creditors, they are decreasing. Creditors is a current liability. Your current liability is decreasing and accordingly your working capital is going to change. The fund is going to change and there is going to be flow of funds in this transaction. Current liabilities and capital. So you pay the creditors often shares. Current liability and fixed liability. So this is what we have, current liability and fixed asset. So in this particular case, what we are doing, we are repaying our creditors by giving them a fixed asset. So we had to pay some amount to our supplier of material and we paid the supplier by giving him a piece of furniture, by giving him the building we own. So if we are doing this kind of thing, current liabilities, they are decreasing and accordingly the working capital is going to change. So if any transaction, it affects current asset or current liability, then it is going to lead to flow of funds. And the other part of the transaction should affect the fixed assets, fixed liabilities. Fixed liabilities are nothing but the non-current liabilities. Non-current liabilities or fixed liabilities, one and the same thing, don't get confused between the two. Or if there is a change in capital or if there is change in fixed assets. So all these kinds of transactions, they are going to lead to the flow of funds. So now let's take a look at those transactions which would not lead to flow of funds. So the transactions which involve current assets and current liabilities. Now, by reading this particular statement, it feels that this should definitely lead to flow of funds, because there is change in current assets and current liabilities. Now, suppose you are paying creditors in cash. My cash is, say, I have a cash balance of say 20,000 and I have creditors of say rupees 15,000. Now this is what is the working capital position of my companies. I have the current asset as only cash, I have the current liability as only creditor. So in this particular case, my working capital is going to be current asset minus current liability, that is 5,000. Now if I am repaying my creditors in cash, what is going to be the situation after repayment? After repayment, my cash is going to remain only 5,000 and my creditors, they are going to be just 0. So accordingly, my working capital still remains 5,000. My working capital remains intact. So there is no flow of funds involved in this transaction. Now, if there is a transaction which involves fixed assets and fixed or non-current liabilities, so you have purchased a building and you have issued shares or debentures for it, your current assets or current liabilities, they are not being affected. If you have a transaction which involve fixed assets and capital, so purchased building and issued shares for the value of the building. So in this particular case also, there is no change in the current asset or current liability. So there is no question of the flow of funds. So what can we conclude here? We can conclude that there is going to be flow of funds if there is change in the working capital position of the company. This is going to change when one part is current part and other part is non-current part. This non-current part can be capital, it can be non-current liability, it can be fixed asset, and this current part, it can be current asset or current liability. If the transaction involves both current parts, then working capital is going to remain intact. If a transaction involves both non-current part, then again the working capital is going to remain intact. So now we can easily answer this question. If you have purchased a building and payment made in shares, so non-current part both, here fixed asset and here capital, so there is going to be no flow of funds. Purchase of building for cash, one fixed asset, one non-current and one current, cash is current, so this is definitely going to lead to flow of funds. Payment made to creditor in cash, so we have already seen in the previous slide that these kind of transactions, they do not have any impact on the flow of funds. So this is going to be ticked out. So the answer is going to be option number B only. Now let's move on to the next question. The first step in the preparation of fund flow statement is, so when you are preparing a fund flow statement, you have to follow a sequence of steps. Now what would be the first step in this particular sequence? Now if you think about it logically, you would easily get the right answer here. Options are preparation of statement of changes in working capital, computing funds from operation, preparing sources and application of fund statement, identifying items not leading to any flow of funds, or none of the above. Now friends, when we talk about preparation of fund flow statement, the first step would be to find out the flow of fund, and the fund, it means working capital. So we would have to find out what is the change in the working capital position of the company. So we are going to find out the working capital for the last year and for the current year, and we are going to find out what is the change in working capital. Change in working capital is basically going to be the fund flow. So we have to find out the change in working capital. So here we are going to list out the different items of current assets like cash, bank, debtors, loan and advance, stock. Every item is going to be there for current asset, and similarly every item is going to be there for the current liability, your bill payable, your creditor, your bank overdraft, any advances you have got, your short-term advances. So everything is going to be here. You are going to reduce current liabilities from current assets. So let's suppose the total of the current assets here, it comes out to 5 lakh. And the total of the current liabilities here, it comes out to 3 lakh. So working capital is going to be 2 lakh. And in the current year, the current assets, they are 6 lakh. And the current liabilities, they are 3.5 lakh. So here the working capital is going to be 2.5 lakh. So we can clearly see that the working capital has increased by 0.5 lakhs. So we are going to understand what is this increase in working capital, what transactions have led to the increase in working capital, and we are going to depict those transactions in the form of a fund flow statement. Now next we have to compute the fund from operations. So there is a flow of funds. We have seen that 0.5 lakhs the working capital has changed. Now what has brought this change in working capital? One can be the case that we have generated funds from our operations. We have sold goods, we have generated current assets from it, we have generated cash, we have generated debtors from it. So this can be one of the reason for the change in working capital. So we have to identify how much funds we have got from operations. This is very similar to finding out the cash flow from the operating activities, the indirect method that we talked about. This is very much similar to it. So in this particular case, we are going to take a look at our profit and loss statement, and we are going to do some adjustments as we were doing in the case of the cash flow statement for the operating activities indirect method. So again, we are going to add back certain transactions. We are going to add the depreciation on the fixed assets. We are going to add any other expenses which we have written off during the year. You are going to add loss on sale of furniture, because furniture you have sold, it is not fund from operation. Similarly, you are going to reduce any other items which are not related to your operations or which do not lead to any flow of funds. For example, this sale of long-term investment, this is not related to the operation, so we are going to reduce it, and ultimately we are going to arrive at the figure of fund from operations. So we would get to know how much funds we have generated from operations. Now there would be a question in your mind, okay, we have computed the fund from operation, but then again there would be many other funds which would not be related to operations, but we may have generated them. What about them? We are going to disclose them separately in the fund flow statement. How this looks like, let's try to understand. So this is the final step. We are preparing the fund flow statement. A fund flow statement is going to have two sides. This can be prepared in a format like this, or we can prepare it in a format like this, that on one side on the top I mention sources, and on the bottom I mention application. So this can be prepared like this as well. So here on the one side we have sources of fund, and on the other side we have the application of fund. So we have all the transactions which would involve the flow of funds, like the issue of shares, issue of debentures, the borrowings have been made, we have sold the fixed assets, we have generated the fund from the operations, and again the decrease in working capital. If the working capital has decreased, it is also written on this particular side. And on the other side, we are going to have different transactions which would lead to application of fund. We have redeemed some shares, we have repaid a loan, we have purchased fixed asset, or we have made loss in our operations. When we computed fund from operations, the figure was coming negative. So this is going to be shown as the application of fund. And again, if we have made any payment of dividend or taxes, this can also be shown here. And if there is increase in working capital, if the working capital has increased, it means we have put in our funds in the working capital. So this is again shown as increase. This is again shown as the application of fund in this fund flow statement. So this is what you have to remember. It has two sides: sources of fund, application of fund, and decrease in working capital, it is shown in the sources of fund side, and increase in working capital is shown on the application of fund side. This is what you have to remember for it. All other things, they are very logical, and you can easily make out if you have understood the concept of fund and what are the transactions that lead to flow of fund. So now it's very easy to answer it. The first step in preparation of fund flow statement is to identify the changes in working capital. So we prepare a statement for it. We prepare a statement of changes in working capital. So answer is going to be option number A. Now let's move on to the next question. In the context of fund flow statement, which of the following is an application of fund? If you have understood the previous question very clearly, this question is going to be very easy for you. Issue of shares and debentures for cash, sale of investment and other fixed assets, fund from operation, repayment of loan, or none of the above. So we have seen that we prepare a fund flow statement, and in this fund flow statement, on the one side we write about the sources of funds, and on the other side we write about application of the fund. Okay, and in the sources of fund we mention all the transactions which would involve the inflow of the funds, which would involve that we get more funds if we have sold the assets, if we have issued the shares, if we have made profits in the company. So they are all going to be the sources of fund. if we have repaid money on loans, if we have repaid the debentures, if we have purchased some fixed asset, if we have made loss in our operations, they are all going to be shown on the application side, and the difference is going to be increase or decrease in working capital, which is again going to be shown here. So in this particular case, I believe you have already got the right answer. So again, we have the fund flow statement here, sources of fund, application of fund, and we already know what transactions are put in the sources and what transactions are put in the application of fund. So now we can easily answer this question. The answer is going to be repayment of loan. The repayment of loan is definitely an application of the fund. When we are repaying loan in cash, what is happening? Loan is what? Loan is a non-current liability. And what is cash? Cash is a current asset. So one current and one non-current, they are being affected. So there is going to be flow of fund. And since our current asset, our working capital specifically is declining in this particular case, we would say that this is a case of application of the fund. In all other cases also, there would be one non-current and one current. But in all other cases, you would find the working capital is increasing. The cash is increasing. You are selling the investments or fixed assets. Again, cash is increasing. You have generated funds from the operations. It is a classical case of the source of funds. So again, the answer here is going to be option number D only. Now here's a very simple question for you guys. Which of the following would result in increase in working capital of an entity? Working capital, automatically the formula should pop up in your mind. This is going to be current asset minus current liability. Okay. Decrease in current asset, increase in current liability, decrease in current liability, all of the above or none of the above. So what would lead to increase in working capital? The formula is very clear. Current asset minus current liability. Now suppose I take the figure of current asset as 10 lakh and the figure of current liability as 6 lakhs. Okay, I take this as the base figure. So if I increase my current assets, if I increase my current asset to 11 lakh, my working capital is going to definitely increase. Earlier my working capital, it was, let me write the working capital, okay, here. So the working capital earlier it was 4 lakh, but now it would definitely increase 11 lakh minus 6 lakh, that is, it is going to be 5 lakh. If I decrease my current asset, if I decrease it to 9 lakh, if I decrease it to 9 lakh, then 9 lakh minus 6 lakh, it is going to be 3 lakh. So working capital in this case, it has declined. If I talk about from the current liabilities perspective, if the current liabilities, they are increased from the 6 lakh, I make this figure 7 lakh. And the current assets, they remain 10 lakh only. So in this particular case, my working capital, it is going to decline to 3 lakh. And if I decrease my current liability to 5 lakh, 10 lakh minus 5 lakh, this is going to be again 5 lakh, my working capital, it has increased. So I can easily make out if any transaction, it increases current assets or it decreases the current liabilities, it is going to increase my working capital. And if the things are reversed, if any transaction, it decreases my current assets or increases my current liabilities, this is going to decrease my working capital. So this is something that you have to remember here. So now we can easily answer this question, that increase in working capital would only happen if the current assets, they increase or the current liabilities, they decline. So option number C, it says decrease in current liabilities. So it is going to be the right answer here. So answer is option number C. So thank you friends. This was our discussion on the concept of fund flow statement. Now this fund flow statement is not as popular as cash flow statement, but a question may be asked in the examination from this concept as well. So I believe I have touched upon all the basics of fund flow statement and you were able to understand all of these. So that's it for today. Bye bye. Take care. All the best.